But people are buying stocks anyway. They're not discouraged, they just think it's a gamble.
Hello and welcome to our YouTube channel where we bring you the latest and greatest in investment strategies and insights. In today's video, we're going to be discussing the top 6 monthly dividend ETFs to earn income in 2023, specifically those with a high dividend yield. Before we dive into the topic, we would like to ask you to subscribe to our channel to get notified about our future videos. Dividend ETFs are a great way to generate regular income for investors as they offer exposure to a diverse range of stocks that pay dividends. Monthly dividend ETFs in particular are popular among income-seeking investors as they offer a more frequent payout schedule. So without further ado, let's dive into the top 6 monthly dividend ETFs to earn income in 2023. 1. Global X Super Dividend ETF SDIV. The Global X Super Dividend ETF SDIV is a popular investment option for investors seeking a high dividend yield. This ETF offers exposure to 100 of the highest dividends yielding stocks from around the world, making it a great option for those looking for global diversification in their income portfolio. The current dividend yield of SDIV is around 7.5%, which is significantly higher than the average dividend yield of the S&P 500 index. This high yield is achieved by investing in a diverse range of companies, including real estate investment trusts, REITs, master limited partnerships, MLPs, and dividend-paying stocks from various sectors and countries. One advantage of investing in SDIV is its monthly dividend payout schedule, which can provide investors with a regular income stream. This can be particularly attractive for retirees or those seeking additional income to supplement their salary. However, it is important to note that investing in high dividend yielding stocks also carries some risks, such as potential for dividend cuts or reduced earnings. Additionally, the ETF's high concentration in certain sectors or countries may increase volatility and risk too. iShares Select Dividend ETF DVY. The iShares Select Dividend ETF DVY is a popular investment option for investors seeking exposure to high dividend yielding U.S. stocks. This ETF tracks the performance of 100 U.S. companies that have a history of paying consistent and high dividends. One of the advantages of investing in DVY is its focus on stable and established companies with a long history of paying dividends, making it a relatively low-risk investment option. The current dividend yield of DVY is around 3.5%, which is higher than the average dividend yield of the S&P 500 index. DVY also offers diversification across various sectors, with its top holdings including companies from the financial, consumer goods, and industrial sectors. This diversification can help reduce risk and volatility as investors are not overly exposed to a single sector. Another advantage of investing in DVY is its lower expense ratio compared to other dividend-focused ETFs, making it a cost-effective way for investors to gain exposure to high dividend-yielding U.S. stocks. However, it is important to note that, like any investment, there are risks associated with investing in DVY. Its focus on high dividend-yielding stocks may leave it vulnerable to market volatility and potential dividend cuts or reduced earnings. 3. Invesco S&P 500 High Dividend Low Volatility ETF SPHG. The WisdomTree U.S. Quality Dividend Growth Fund DGRW is an ETF that focuses on high-quality U.S. companies that have a history of paying consistent and growing dividends. The ETF invests in companies with strong fundamentals such as high return on equity, low leverage, and high free cash flow, which can help ensure the sustainability of their dividends. DGRW aims to provide investors with a combination of income and growth potential as it invests in companies with strong earnings growth potential that are expected to continue to increase their dividends over time. The ETF has a current dividend yield of around 1.5%. One advantage of investing in DGRW is its focus on high-quality companies that have the potential for long-term growth and stability. This can help reduce risk and volatility, as investors are not overly exposed to companies with unstable or inconsistent earnings. However, it is important to note that DGRW's focus on growth may mean that it has a lower dividend yield compared to other dividend-focused ETFs. Additionally, investing in growth companies may also carry some risk, as their share prices may be more susceptible to market volatility. 4. WisdomTree U.S. Quality Dividend Growth Fund DGRW. The WisdomTree U.S. Quality Dividend Growth Fund DGRW is an ETF that focuses on high-quality U.S. companies that have a history of paying consistent and growing dividends. DGRW aims to provide investors with a combination of income and growth potential by investing in companies with strong earnings growth potential that are expected to continue to increase their dividends over time. DGRW's investment strategy targets companies that exhibit strong fundamentals, including high return on equity, low leverage, and high free cash flow, which can help ensure the sustainability of their dividends. This focus on quality companies can help reduce risk and volatility, as investors are not overly exposed to companies with unstable or inconsistent earnings. One of the advantages of investing in DGRW is its focus on long-term income growth potential. By investing in companies with strong earnings growth potential, DGRW aims to provide investors with a growing income stream over time. The ETF has a current dividend yield of around 1.8%, which may be lower than some other dividend-focused ETFs, but its focus on quality and growth potential can provide a more sustainable and reliable income stream in the long run. However, it is important to note that investing in growth companies may also carry some risk, as their share prices may be more susceptible to market volatility. Additionally, DGRW's focus on U.S. companies may limit global diversification in an investor's portfolio. 5. Global X Super Income Preferred ETF SPFF. The Global X Super Income Preferred ETF SPFF is an ETF that offers investors exposure to a diversified portfolio of preferred stocks, which typically have higher yields than common stocks. These preferred stocks are often issued by companies in the financial, utilities, and energy sectors, which can provide investors with exposure to a range of industries. SPFF aims to provide investors with a high level of income, making it a great option for those seeking regular income from their investments. The ETF has a current dividend yield of around 5.5%, which is higher than the average dividend yield of the S&P 500. One advantage of investing in SPFF is its focus on preferred stocks, which can provide a stable income stream due to their fixed dividend payments. Additionally, preferred stocks are generally less volatile than common stocks, which can provide some stability to an investor's portfolio. However, it is important to note that investing in SPFF does come with some risks, including interest rate risk and credit risk. As interest rates rise, the value of preferred stocks may decline, and there is also the risk that companies may default on their preferred stock payments. 6. First Trust TCU Opportunistic Fixed Income ETF FIXD. The First Trust TCU Opportunistic Fixed Income ETF FIXD is an ETF that invests in a diversified portfolio of fixed income securities, providing investors with a way to generate income with lower volatility. FIXD's portfolio is actively managed by TCU Investment Management Company, which seeks to identify and invest in fixed income securities with attractive risk-adjusted returns. By investing in a range of fixed income securities, including corporate bonds, mortgage-backed securities, and government bonds, FIXD aims to provide investors with a diversified income stream while also reducing overall portfolio risk. The ETF has a current dividend yield of around 3.5%, making it a suitable option for income-seeking investors. It's important to note that while investing in fixed income securities can be less volatile than investing in stocks, it is not risk-free. Bond prices can fluctuate based on changes in interest rates, credit ratings, and other factors, which can impact the value of the ETF. Therefore, investors should carefully consider their risk tolerance and investment objectives before investing in FIXD or any fixed income ETF. So, monthly dividend ETFs offer a great way to generate regular income for investors. The 6 ETFs we discussed in this video are some of the best options for investors seeking a high dividend yield in 2023. As always, we recommend conducting thorough research before making any investment decisions. And with that, we'd like to remind you to subscribe to our channel for more informative content like this. Thank you for watching.